Hello and welcome to this edition of All About Your Company. Now, within the power ecosystem, you're seeing some good traction, but what within the power ecosystem is standing out? Well, here's a company which is delivering, or rather committed to deliver 25% growth, Transrail Lighting. This is based on the commentary that they've given. They have a fairly steady margin. Of course, there are risks at this point of time, commodity cost inflation coming through. But what we are likely seeing is 14 times earnings is what this trades at 1 year forward, which is at the lower end of the valuation band that it has always traded at. So we'll try and get a perspective of what's playing out. So that's the first part. But therefore, Transrail Lighting, it's been very choppy. This is the 1 month chart, but let's pull up the 6 month as well. Let's flip the chart. This is, of course, with regard to the negative returns. Can we flip the chart? You can see the number of whipsaws that the chart has gone through. It bottomed in February, rose back up to around the 600 levels, again came back off to around 450. Again, it's seen a bounce back. We'll try and get a perspective as to what's playing out exactly and what the forward-looking commentary indicates with regard to both the stock as well as the valuations when we are looking at it. In terms of what the company is about, taking a step back, trying to give you a lens into what it does. It's an EPC firm, technically speaking. 90% of its revenues are from the EPC space, which is engineering, procurement, as well as construction. And within the power equipment and the T&D space, which is transmission and distribution space. It manufactures towers, conductors, monopoles. It operates across 63 countries, so it's not restricted to one. And it has a market cap of around 6,500 crore. That's a broad brush, the overview. Now let's talk about the products. It does transmission lines, and it's an integrated player. This is what you need to understand. It does the manufacturing plus it does the EPC, which is what differentiates it, which is what gives it a slightly better margin profile, right? So transmission lines, substations are obviously stations between two transition lines. Think of them as a train railway station or a junction of sorts between transmission lines. That's what substations are. Towers and conductors, which is again part of the T&D ecosystem. Monopoles are single poles on which electricity line passes. You would have seen that in a lot of parts of India. There are then civil works. It does bridges, tunnels, cooling towers, elevated roads, railway electrification as well, overhead systems for trains. Solar EPC is also what it's gotten into, which is the full solar plant design and installation. They've won an 80 megawatt odd order. And poles and lighting, which is utility poles and LED street lighting, is also what they have ventured into. So it's a slightly more diversified kind of play, but 90% is EPC services. That's something to understand. 10% is manufactured product sales is what they do. This is broad level. It's 91 and 9 approximately based on FY26 numbers. Geography, there's a good split. 50% India, 50% rest of the world. That's really the split. It's 49-51, but ballpark it's that. When you're looking at the business model, it has 5 integrated facilities across India. And they've just set up a new tower plant in Maharashtra. The tower capacity is now double from the 84K MTPA to 172,000 MTPA, so substantially more. You've got a very decent pipeline in terms of order book. We'll speak about that. But tower capacity itself is set to go up from even 172 to 196 as efficiencies start to build in. Also, conductor expansion is what they've taken. The conductor to go up it's currently at 24. It should go up to 41 kilometers of conductor capacity, and which will go and ramp up to 49,000 kilometers of conductor capacity. So from 24,000 to 41,000, that's the immediate leap. We'll try and get timelines on when that comes on stream. Last of all, who are the customers for Transrail? Well, government companies is 55%, or rather 55% of domestic is government, and 20% of international is government. So any way you look at it, 30% of the total pie is domestic government, and 10% of the total pie is international government. So 40%, largely, approximately 40 to 45% is government orders, 55% is private. And in private, especially in domestic, you have some strong names out there in terms of relationships. Let's talk about the financials, and this is where some of it starts to stand out in terms of the numbers. The growth has been extremely strong. They've grown at 31% CAGR over the last 3 years. What we've seen is currently the top line sits at sub 7,000 crore. 20 to 25% growth is what they are continuing to pencil in on this higher base as well. Let's talk about EBITDA, and EBITDA has grown at 46%. Margins have actually gotten better. Generally, there is a pass-through with regard to commodity costs for a bulk of the top line, but we'll try and get an exact estimate as to how much of it is passed through, how much of it is absorbed. My understanding is around 70% is a pass-through, which is based on contracts, 30% is absorbed. So you might see some bit of hedging on the absorbed component, and there will still be some bit of margin impact if at all commodity costs continue to remain elevated. But what you've seen is a flattening of the EBITDA. Multiple reasons. You had employee costs which were elevated because of the new labor code. There was also some bit of execution challenge which played out in Q4, due to which you saw a slight bit of fall with regard to the margins in Q4 as well. So broadly, this is the setup with regard to EBITDA, but you've not seen as strong an EBITDA growth in FY26 as you did in FY25. That seems evident. Profitability, 71% growth is what we've seen. Again, the margins with regard to the top line, 404 crore on the 6,000 or nearly 7,000 crore adds up to around 6 to 7% margin. That's really the profile in which they are operating in. That's obviously the EBITDA margins in front of you. They've fallen from the highs of FY24 and FY25. So that's the texture in which we're seeing the margins move. They've guided that margins will remain in the 12% odd band. So that's what we can expect in terms of the margins even going forward. The 15%, there was a slight bit of elevation with regard to margins when it hit 15%. Anyway, let's take it across and try and understand how the order book has shaped up. And you'll see 16,313 crore is the order book at the end of FY26. Revenue was around 7,000 crore, so 2.4 times book. They've won a large order today as well. And that keeps the stock in focus. That is one. But of course, the order book to bill is fairly healthy and has remained so over the last few years. They've been fairly consistent. 10,000 crore of new orders is what they're penciling in for FY27 with a 25% growth on the top line. That still bodes very well with regard to visibility on the order book side of things, because that'll take the order book to around 20,000 crore odd. And it'll be approximately 2.2 times book to bill, if at all that were to translate. The fourth piece is with regard to cash flow, and this is where a possible concern can be pointed out. Inventory build-up, also receivable build-up, some government orders and the like. So there is some bit of receivable build-up there, and as a result of which the conversion hasn't happened in FY25 and FY24. But FY26, it's also the growth, right? Some bit of the growth also, pushes receivable levels higher. But what we've seen in FY26 is there's been a bit of an unwind on that count. So that is surely positive. You've seen a decent net cash flow also translate for Transrail lighting. So that has also happened. I'll just quickly also mark out the receivable days, because that becomes important for a company like Transrail, and it'll give us some texture on what's playing out. In terms of the debtor days, they've fallen from 100 in FY22 to 90 now. Inventory days, though, have remained slightly on the elevated side. And the working capital cycle has shrunk from FY24, which was at 52 days. It's now shrunk to 41 days. So broadly, that's the direction, if at all. That gives you a good texture on the direction. It's obviously on an improving trend. How much can it improve from here really is the question, and we'll try and get a sense. In terms of the in terms of the return ratios, let's pull those up as well. And what you'll see there is very strong return ratios. So no concerns with regard to the ROCE at least. It's also got debt on the balance sheet, by the way. I'm sorry, let's quickly pull out the balance sheet. That's something we've missed. When you're looking at the book value, it's around 2,281. So it trades at around 3 times book. And one more thing is the debt. Let's pull out the debt number. It's been flat over the last 3 years at least. It's been around 650 odd crore. And you've already done some bit of capex, which has already flown through. So To that extent, it's a decent picture with regard to the balance sheet in terms of debt. The cash bank balance that they sit on is 750 crore as well. But obviously, there's some bit of working capital which is required when you're growing the business at this pace. We'll try and get a sense as to whether that working capital days shrink or not. That will be one of the crucial pieces that we will try and track when we speak with management. Now, we spoke about return ratios, positive. Let's look at shareholding now. 71% owned by the promoters, so no concerns with regard to ownership. You've got very little FI and DI interest, but of course, it's largely been around the double-digit kind of number, just about the double-digit number in terms of FI, DI ownership. The public owns the balance in terms of the shareholding pattern. Now, let's talk about valuations. 14 times one-year forward earnings is what this one trades at. The one-year average is around 21 times, and the one-year range is around 13 to 29 times. That's broadly the range. So this trades at the lower end of the range, but you've seen plenty of choppiness on the stock price, and that's what you want to factor in. And that kind of reflects on the way in which valuations have moved as well. In terms of analyst recommendations, there are only 3 analysts tracking this one, and therefore we're cautious. But three buy calls, no sells, no holds, 42% upside is what analysts are seeing on this one, but only 3, of course, given the size of the company, that makes sense. Broadly, this is the setup. Let me bring on board Mr. Randeep Narang, who's the Managing Director and CEO at Transrail Lighting, joining us. Mr. Narang, great having you. Let me first start off with the latest order win that that has translated to you today. Talk to us about the nature of the order. Talk to us about whether there has been any change with regard to pricing, given the fact that commodity prices have inched upwards. Are you passing that through? Is that visible when you're bidding currently?
Thank you for having me over. Pleasure to be here.
Very good having you.
Yeah. So principally, we got new orders worth 575 crores. These are all fresh orders which were bidded recently in the last 2 months. And of course, we've taken the latest pricing for all the elements, and therefore we are safe and good in terms of the margins. Mix is around 200 crores is international, the rest is domestic. We've got a 500 kV job also from one of our marquee private clients. The rest is civil and pole. So it's a very good, healthy mix. We also have another L1 of 400 crores, which is from international. So we've started the year in a good note, and we are very comfortable with the quality of the order book we have.
Understood. And with regard to the kind of headwinds that you're seeing with regard to commodity costs, how much of that is a pass-through? Can you give us some color?
So principally, we look at all bidding which we do, whether it's domestic or international, and we look at all the commodity trends, and we bid based on the current price and certain buffers we keep. Around 35 to 40% is pass-through, and the rest we buffer in terms of our cost structure. And we look at that happening in a regular basis, and all bids are very carefully analyzed based on the cost, the ground reality, and therefore we bid with a very clear risk assessment matrix, which helps us to understand the ground realities and the various trends of products which we buy.
And what about, so you've done 1,000 crore of orders in the last 2 months. Likely, is that the correct understanding? And your goal is to do 10,000 by the end of the year. For the rest of the year, you'll have to continue to win maybe 9,000 odd crore. Is that the right way to think?
Yes, that's a fair positioning of our opportunity. So there is a huge opportunity in India itself. We're looking at a 1 lakh crore order opportunity. As you know, the National Electricity Plan has panned out to almost 9.12 lakh crores of order opportunity in the next 5 years. So we see a good traction. Even our big clients have huge capex plans. So we are seeing a 10% kind of market share. So, and also internationally, there are 50 to 60,000 crores of orders. We are well spread in various geographies, working in almost 22 countries currently. So for 10,000 crores of order intake plan, we are quite comfortable, and we feel that we can achieve it with a good margin profile. Also, we have a 16,000 crores of unexecuted order book, which is, as you rightly positioned in your presentation, is 2.2 years of book and bill. So we are comfortable to look at fast track growth happening this year also.
All right. I know you've given your growth guidance. I'll come to that in just a minute. So I'll come back to the margin and the raw material piece of things, right? You've suggested that around 35 to 40% is a pass-through in terms of a price increase. Typically, maybe your book-to-bill execution period maybe at least a couple of years, right? Given the kind of book-to-bill you have and the kind of revenue that you have currently. And
Yes.
therefore, you run that risk of execution. Is that at all a large risk for you? And how much, if at all, would the downside be on your margins if at all raw material prices were to go up?
So if you see, we have a order book which is spanning 2.5 years to 3 years, 24 months to 30 months principally. And therefore, what is important is that we see a horizon not only for the next 6 months, 12 months, but for the next 18 months. So our execution plans are therefore tailor made to look at how do we execute within the timelines of the contract and yet make sure that the client is comfortable and we run our factories full. So we are really not concerned. Yes, there are pressures because of global geopolitical situations. And luckily, we don't have too many orders in the Middle East. We have only 1,000 crores, which are just in the startup stage. So we are not really hurt in that part of the world. And in India, what we have, and in internationally, we are very clear on the execution planning and running our factories full. So there will be, let's say, disruption in supply chain, but those are only postponement of the execution by a month or so. Otherwise, we are good to go.
Yeah, I'll talk about that because Q4 was a tough quarter for you. But before I get there, so what's the margin hit like if in a bad cycle? If commodity costs were to remain elevated for a prolonged period of time, what is the lower end of the margin bracket that you operate at? Do you look at EBITDA margin? Is that the right metric? Is PAT margin the right metric? Give us a sense.
So EBITDA is the right margin to track. We have given a guidance of 11.5 to 12% last year. And despite a tough last quarter, we ended the year at 11.9%. We've given a guidance of 11% this year, and we've looked at some of the disruptions which may have, but we are feeling comfortable that yes, with situations easing out, we could look at a better than 11% opportunity. But that is for wait and watch and to see how it pans out.
Okay. Mr. Narang, I'm going to have to take a very short mandatory commercial break. I'm going to do that. I'm going to come back to you. We're going to try and understand how Q4 has evolved and how the macro for FY27 is setting up. What Mr. Narang is essentially saying is your margins will come down from 11.9 to 11. What's the headwind there? And where is execution going to be like for FY27? We'll take that on the other side of this break. Stay with us. Welcome back. Q4 was a tough quarter for Transrail and multiple headwinds. One was, of course, the geopolitical issues. Mr. Narang, that kind of held you back with regard to the numbers. There's also some labor disruptions which played out, and you've to some extent been able to resolve it, is the understanding. Give us a sense. Q4, what has played out? Q1 FY27, how is it playing out up until now?
So I think before I set the canvas for this discussion, even at 11.9%, we are one of the leading companies in terms of the margins in the industry, EPC industry. And even 11 plus is what we're talking about, which is again the best in class as far as I understand based on the results of various people. So the opportunity for us from a healthy order book to execute is very much there. In one of my discussions with one of the investors and media, I had mentioned that in Q4 and prior to Q4, we finished 20 projects, which we closed in terms of execution. And in the Q4, we were in a startup phase for projects in terms of design, engineering, and approval. So there was a little slowdown in terms of the manner in which we could execute faster. So therefore, we had some headwinds from a supply chain point of view. But as I said, things are stable for Q1 27. We are managing the disruptions because when we see the disruptions happening, even our sub vendors and sub suppliers get troubled. And therefore, it is, of course, one has to go right down to the bottom of the supply chain to ensure supplies happen to us in our factories and we can ensure the deliveries to our clients.
And has that happened, Q1 FY27? Has that completely normalized, or there is still some bit of headwind left
So,
for
as I said,
Q1?
it's stable and there is disruption, but we are managing it well.
Understood. And with regard to the margin count, you've brought the margin number down from 11.9, which is a premium, I understand, to 11%. What does that indicate broadly? Is it because of certain labor issues and higher employee costs? Is it because raw material costs have gone up for you? Reasons for that, and for how long will it be 11? When does it go
So
back towards 12?
it's a mix of all the points you mentioned. Rightly so, all three of them. And this again depends, and we are hopeful that these margins can definitely improve in H2, and therefore we are quite bullish. And more importantly, the order book quality is very good. So we can definitely improve from where we are, but this is for wait and watch as things in the geopolitical Middle East settle down. We will be in a better position to look at this in Q2.
And how quickly does it turn around? If at all there's a resolution tomorrow, for example, will it take a month, a couple of months? Give us that timeline indication.
I would say 3-4 months for sure. Q2
Okay,
would be a better position if things normalize right away.
I understand. And with regard to growth itself, is that under challenge at all at this point, or the 20 to 25% kind of growth guidance remains so? And this is despite West Asia. Would you say that if West
Yeah.
Asia resolves itself, you grow faster?
So we are looking at 20-22%. 25% can be a possibility also. We have an order book to back it up. And the execution planning has been done based on what the current market scenario is. We don't have too much of orders in Middle East, as I said, only 1,000 crores, which are, in a startup phase. So, but we are comfortable that we will be able to meet our revenue growth guidance.
Okay. You've started a new facility which allows you an expanded capacity. From 84, you've gone to 172,000 MTPA. Give us a sense as to when did that happen in terms of timeline, and what's the capacity utilization now on the fresh capacity that you have?
So that's a very good question. Actually, we started in end April. So this factory at Butiburi is ramping up, and we are looking at a capacity of around 4,000 tons a month. And we've reached a stage where at least 50 to 60% utilization is happening, and we'll ramp up in the next month, going further up to 95%. So it's a startup phase which will immediately improve. We have a lot of experience in tower manufacturing with our Dioli factory, our Baroda factory, and normally our capacity utilization is 90 to 95%.
Perfect. So you do what? Roughly, if I've done the math right, around 120 to 130,000 MTPA from
No, no,
this segment alone.
we will look at close to the capacity utilization of 160 to 170 for the year. So it is
For the
for this
FY27.
capacity just started ramping up, and in
Right.
the next month it will be fully ramped up. So for the annualized numbers, we'll be very close to our full capacity. And I said 90-95% is what we will do.
I understand. And so any reason why then you're guiding only for 20 to 22% growth? Is a lot of this, substitution for something that you're already buying? Can you give us some sense around why
So
wouldn't your revenue also
that
rise
is
in?
a Okay. So it's not dependent on towers alone. It depends on the ground
Right.
reality, the execution plan, the project life cycle, the
Correct.
terrain, the approvals, the ROW. There are multiple factors along with the backward integrated supply chain we have. So we are in a very good zone where we do towers, conductors, monopoles ourselves, including heavy engineering, designing. So this is not area to hamper. Looking at a growth on a good base of close to, as you said, 7,000, yes, is reasonable, keeping in mind the current reality of the ground reality. And if things improve in terms of execution, we will try and better this. But at this stage, 22% is a very decent number, and we believe that it is something we can achieve with our execution skills.
Understood. Give me also a sense with regard to the other executions which are in the pipeline. You've done a decent amount of capex. Are there any timelines with regard to especially on the conductor side of things, how execution has played out for you, or when is it going to play out for you?
So, as you rightly said, 41,000 will happen in Q2, end of Q2, and the balance will happen another 2 months. So, we by December we'll be fully functional to 49. October 41 is what we are looking at.
Okay.
41,000 kilometers. Yeah.
Right. Two other points that an investor would love to know with regard to Transrail. One is with regard to receivables. Is this now the level with regard to both working capital and receivables that you operate at? Can you improve this any further? Will there be some bit of unwind in FY27? How should one look at cash flow?
So, if you see, our working capital days have come down from 91 to 81. There has been a very concentrated effort, focus to unlock all our receivables. And we believe that this should be sub 80 this year. There is a concentrated program, cross functional collaboration, and we want to continue this. If you recall, our overall net cash improved from 400 odd 15 crores to 800 odd crores. So the cash flow from operations has improved dramatically. So we believe that this is something which we will continue and better in this year.
What do you do with the cash flow that comes your way, Mr. Narang? Do you put it in, do you go repay your debt to some extent? Do you continue to expand because demand looks strong, your capacity utilization will ramp up very quickly in FY27? What do you do with the cash?
So we are looking at, of course, last year our net debt came down from 502 crores to 274. That was last year. So we use for internal accruals for our capex. We also use it for growing our business and also reducing our debt. So all this, all three facets are looked at very carefully.
Okay, could you give us a split, some indicative split on how the cash flow will be utilized?
Well, mostly it is for growth, almost 50 to 60%, and the rest is for
Okay.
net debt and capex.
Perfect. Mr. Narang, thank you so much. You've been generous with your time and you've given us plenty to think about with regard to Transrail. Thanks so much for coming
I'd
in
like
and
to
speaking
just
to us.
say one word before we, close this
Please.
conversation. So for us as a company, as a team, we are seeing consistent growth on revenue. We are also, as I said, the margin is one of the best in the industry. We believe that we will continue so with a strong order book and margin profile. And for my investor community friends, we believe to give the right guidance, the fair guidance, and we hope to continue in the same way. Thank you so much.
Thank you, Mr. Narang, for those closing comments. Out of time, viewers, on this edition of All About Your Company. Thanks so much for tuning in. More action on the other side. You want to stay tuned here into ET Now.